Welcome to TMS Insights. We're bringing to the end reporting season and also August, which has been a bit of a volatile month for the market. Let's go into the reporting results with Ben Clark here and Jeremy Hook, of course, bring the update again. Now, Ben, this reporting season, I guess not a lot was expected, and overall we now know that there were probably a few more misses than beats on expectations. 37% of companies missed expectations, 21% beat expectations. We feel probably overall we got the good side of that with a lot of the stocks that we cover.
Yeah, only one or two that sort of disappointed us across portfolios, and certainly there's quite a number that exceeded our expectations, and we saw some good share price reactions too. But it's a bit of the same picture, Jeremy. You know, if you look back at FY19 across the ASX 200, 0% earnings growth. Now that, of course, you know, there's some companies that did a lot better than that, some that did worse, but across the market it was zero.
And what it means going forward now after these numbers, everybody, of course, is mainly interested in what is next.
Right.
You know, the windscreen rather than the rear view mirror.
Absolutely.
And the windscreen saying earnings growth for the market for the current year, the fiscal year 20, will be 7.5%, of which 2/3 will come from the resource sector.
Yes, and the industrials, which are everything ex resources, expected to deliver about 1.8% earnings growth.
Pretty low, you know.
Pretty low. There are some green shoots in a number of companies, but I would say, you know, we've been, I think ever since the GFC, the market has thought that earnings were going to be better than they are every single year and consistently downgraded. So hopefully, you know, with the interest rate settings where they are, we'll see a bit of a change in that. But
and it's important to understand averages, of course, too. If we're finding better than average stocks with better than average growth, it's not going to really be a concern there.
Yeah, we don't own the ASX 200, and you know, if a stock's 8% of that, we don't have 8% of our clients' portfolio in that. So our portfolios have taken a very different path, particularly over the last month, I think, to what the market's done.
And that's also shown out in the ones which have been more downgrades from the brokers overall. So let's get into that. But firstly, say on the backdrop of that, the market actually declined roughly 3% for the month, which was a little bit more than what it gained in July. So there were big macro offshore events, trade war concerns, global growth issues that sort of dominated.
Yeah.
But I think the sense is it might have felt to an investor like it was worse than that.
Absolutely. You know, I think I've certainly felt from clients that they feel like it's worse than that. And, you know, I put it down again to a lot of the headlines and that you hear each day. But a 3% correction after the 7 months that we had previously is just a small little bump in the road to me. And, you know, it's like we knew with the Trump presidency we were going to have periods like we've had over the last month, and there's little that can be done about it. It provides good opportunities, I think. But it's just, you know, if you look at the journey over the last couple of years since this trade war in particular has kicked off, markets and portfolios are significantly higher than they were 2 years ago, and I'm sure that'll be the case over the next years.
And I think, just moving on from that, the key thing with a person like Trump is watch what they do rather than what they say, because there's quite a difference. And economically, the story of the US is strong. So it's good. Now, this takes us into a couple of stocks exposed to the US, and both in the plumbing space, Reliance Worldwide and Reece. Now, Ben, Reliance gave a profit warning in May, and its share price got really hit. We had all our eyes on this result, and it actually turned out to be better than expected.
Yeah, they delivered, I think, a great set of numbers. They are facing some issues in the UK with uncertainty over Brexit. They had the weather event, or the weather event that didn't occur, with a lack of a cold, freezing winter in the south. But despite that, the company, I think, has managed that period pretty well. They've given quite decent earnings guidance for the year ahead because they've stripped out any probability of a freeze, so there'll almost be an upgrade coming through if a more normal weather year hits the American market. And we still continually hear this story of a long-term structural change in the way that plumbing has been done in America, of which they're at the forefront of. And interestingly, on the Reece, actually, the CEO of Reece actually mentioned Reliance on his call. It was Reece is now the third largest plumbing operator in America. They bought a business called Morsco, and he was asked about sort of trends in the US market that are different to Australia. Well, interesting comment. He said the US plumbing industry is about 15 years behind Australia in terms of technology and environmental. But he did say that push to connect is a real trend.
Which is great for Alliance. Good to hear it.
Yeah.
Potentially
From someone else.
another player in the space saying that. Now, you mentioned Brexit, and that takes us to Link, which reported this week. And Brexit concerns have been worrying Link. Obviously, they operate in the United Kingdom, and nobody knows how this will play out.
No.
And obviously, this week Boris Johnson made a move on Parliament, which will circumvent debate about this. But October 31's looming, and Link's not sure how it'll go. But that was a good result given a tough year for Link.
I think so. This is, I would say, another sort of similar to Reliance, where it fell out of favour with the market, but the numbers when they were delivered were actually pretty good. Interestingly, the CEO of Link is now saying the worse the Brexit, the better for Link, because they are completely prepared for chaos,
Right.
and actually they'll see a tailwind of earnings if that does occur. But they have had to wear a lot of costs last financial year to build out that capacity to try and plan around the unplannable. The other thing I just quickly mentioned with Link is I think they might be sitting on one of the best technology businesses in this country,
PEXA.
which is PEXA.
Yeah.
The EBIT line of PEXA tripled in the last 12 months, and that will be a name that not many people have heard of, but I think in years to come they will.
They will have used the service one way or another.
Yeah, absolutely.
That's terrific. Let's get on to Ramsay. Obviously, we're talking about a bit of Europe here, and the stock has had a recovery this year. It's been a terrific performer over decades, but the last couple of years haven't been as good, and some changes in the private hospital space have impacted them. Exposure to France slowed them down, but a solid result from Ramsay.
Yeah, I thought this was one that didn't really beat expectations or miss. It was pretty straight in line. He did make some interesting comments. He said Boris Johnson is pro-private insurance and also has committed to putting more money in the public health system. So he actually thinks that Johnson will be a good win for their business, but he is a bit concerned about the movement of people due to Brexit and getting the right staff and all those sort of things. It must be so hard to run a business in the UK.
You need things to happen, and we know that even here with our election and the joy we got after the pressure we felt prior to the federal election here in May. So
nowhere near as much writing.
Nowhere near as much. Woolworths, a very good second half result delivered by Brad Banducci and Steve Harrison, which confirms they're in a good place. But interestingly, we've taken interest in the Endeavour drinks and hotels spin-off, which will happen early next year.
Yeah, well, one thing I think is one of the best statistics you'll find is just how successful demergers typically are. Acquisitions, not so much. Acquisitions always sound a lot more exciting. Demergers typically lead to much better outcomes for shareholders. So Woolworths is going to spin off its pubs and clubs, the poker machines, Dan Murphy's, all of the liquor business, and this could create a lot of value for shareholders within the sense.
And we're looking forward to that. And it'll actually change the discussion about Woolworths and Wesfarmers even further. We encourage clients not to think of them as two supermarket stocks comparable anymore. Obviously, Wesfarmers has demerged Coles despite retaining the stake. It reported as well, Ben, and Bunnings is just so dominant in that group.
Yeah, absolutely. And another great result from Bunnings. Officeworks is pretty consistent business in there as well. I think it's always just interesting hearing from Rob Scott. You know, Wesfarmers is the largest employer of Australians as a company. And the message very much from him was that everyone is just too negative in Australia, that the economy, he feels, is doing a lot better than people give it credit for, and that there's room for investment and room for growth. And, they're clearly trying to branch out into some interesting new areas as well. But I thought this was a really good, consistent result. Wesfarmers has been a great performer.
Absolutely, really. Particularly since the demerger of Coles. And if you got out of Coles and put it into Wesfarmers, you're happy, that's for sure. A couple in the hot tech space, Afterpay, which has just been phenomenal in share price, budding subscriber and revenue growth, and Appen as well, Ben, which has had terrific numbers, but gee, volatile share price.
Incredible reaction, up 10% and down 10%. I mean, I think there's a bit of concern about their latest acquisition, and it hasn't quite hit the revenue rates that the company told the market to expect, but they were at pains to point out only 2 quarters, and the third quarter had returned to what they were hoping for. There's still, I think with both of these companies, just huge addressable markets, massive structural change going in their way. Appen is now the second largest provider of data to artificial intelligence. You know, that's got to be a very good area to be in. And Afterpay is just continuing to do an incredible job executing. The rollout into the UK is now happening faster than the US, which is happening a lot faster than Australia. 16% of purchasing adults in Australia now use Afterpay every month.
That's amazing, isn't it? And we won't talk at length about it today, but Thorny Technologies is a TEK, is an owner of Afterpay and a good way to get exposure. We'll bring that up at the next Insights. In the yield space, Ben, Spark Infrastructure reported a nice yield. They did mention about the yield going forward and distributors' guidance a bit lower with regulatory issues.
So what's going to happen here is we're going to see a slight reduction in coming years in the cash distribution that Spark pay, but we're also going to see some franking credits applied to that cash distribution. Spark's on a great yield. I mean, the infrastructure stocks have all been bid up pretty hard, so the yields now are not as attractive as they were. Spark looks like the sort of the standout to me, although it is probably the more boring of the...
Sure. In the yield space, we listened to this morning was Vital Harvest at the end of the season. Interesting, some good and some not so good in that result, but overall we're quite happy with that.
Probably the interesting part was Costa Group sound like they're under a fair bit of pressure and are providing data as freely as they were to Vital Harvest. There's some pretty interesting things in this
water license, that's amazing.
But water assets are up 46% since they floated, and you know this is a longer term play for us. In 2026, a lease with Costa will have to be renegotiated, and if you're still holding the stock at that time, the terms look incredibly favourable to Vital Harvest.
Just lastly, before we go, Macquarie went due to report in this period. It came up with an earnings update, which was solid, no real surprise. But they raised $1 billion in a placement, and they put a share purchase plan to shareholders at $120. This was good. Some people were unsure, Ben, whether this was a protective move and perhaps a bit pessimistic, or actually a really good opportunity for them to grow their business and to get extra capital to do that. And I think we feel very positive about Macquarie and the upside in it, and they use capital well. So this is something we'll talk to shareholders about.
Definitely. I think Macquarie were one of the first banks to really spot the opportunity in infrastructure, and they've become sort of the global expert in how to package and own and to provide solutions to governments and councils, etc. So I think where interest rates have come down to, and we've spoken a lot about bond yields, the demand for infrastructure is just one of the no-brainer sort of areas you can see over the next 20 years. Particularly, a lot of the world's infrastructure is ageing very rapidly because governments haven't kept a pace with it. So I think this is, opportunities. Now's a good time to raise. I'm sure it's going to be a good share purchase plan to take up, but we'll be in touch in future weeks about it.
There's quite a bit going on. So, but that's a wrap of the reporting season, which has been busy, and we look forward to bringing you an update of the TMS Insights in September.